Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said millionaires don't need astrologers, but billionaires do. And so we begin. Today is Tuesday, March 19th, 2024. No interesting data coming out today, but tomorrow we have the live FOMC interest rate decision, which is already 100% that we're not moving interest rates up or down. And at 2:30, Powell talks. I want to share that from Gareth Solway's Trading the Close today, he saw bullishness in markets. He interprets this as pricing in a perhaps more dovish stance. I mean, I understand that perspective. Right now it's something like 40% no cut, 50% cut. Let's check that. So as you can see, this is from CME Group FedWatch tool. 60% chance of cutting in June and only a 36% chance of not cutting. The idea here being, there's a possibility that he'll say, okay, we're looking at a cut in June, and then it will likely raise the possibility of a cut in June. And lower borrowing costs is good for business. It allows them to be able to make more profits and hold on to their earnings. And so naturally, it makes the value of stocks actually higher. Even though they're already probably overpriced in general, the whole stock market, from a base layer, they are worth more, and so that can give a little bit of a boost. So I agree. That's why we can see some reasoning for today's rally in markets. It wasn't like crazy rally. Again, the markets in general, if you look across the board, everything's kind of going sideways. We're waiting to see, what is he going to say? Is he going to say something dramatic? Is he going to say, we're going to raise rates because inflation is still high? My guess through my crystal ball is neutral. I think they're trying to be neutral on purpose. I think they're just going to say, we're data dependent, so we'll see what happens. We're going from meeting to meeting. That's what they've been saying. And I don't see them changing that anytime soon. So with all of that in mind, today's bullishness, I believe, is most likely to reverse tomorrow, before the meeting, during the meeting, and after the meeting. But we will see what happens. When taking a look at the S&P 500, we actually had a all-time closing high. Now, I had been talking about how we're not going to see a new high in the stock market for a long time. I had been saying that with my crystal ball. And on a closing basis, that has already proven to be incorrect. However, if you take a look at Friday, March 8th, we have a topping tail that clearly goes higher than this. And a pattern like this can be a strong top. This can be a top here, and we didn't get to that point today. Now, if for whatever reason Powell comes out and says something that makes markets want to go to the moon, we could bust right through there, and we could keep going up in stock market valuations. But I highly doubt that's going to happen. It's actually fairly clear in my crystal ball, this one. But we'll see. Two charts just to point out, to show what I mean by sideways action. Home builders, we had a big green candle, but we're just going sideways here. We're going straight sideways. And then taking also a look at, that was home builders, also HYT, high yield corporate. risky bonds. This is going straight sideways. I wanted to clarify something I said yesterday regarding, I think this is a top in all markets. I don't mean all markets. So there's a lot of markets that have already been suppressed for a while, including China, including silver. What I meant to say was I see the same sort of sideways action. And so, you know, if this is a top in the S&P 500 and the NASDAQ, you know, maybe investors will be pulling out of there and going into areas that might start seeming, you know, undervalued. They're undervalued. They look undervalued to me, and so, you know, how can they not look undervalued to other people? You know, you look at some of these longer term charts, and there's certain things that are just blatantly obvious to me that they'll be not so undervalued forever. You know, eventually you have to realize how much earning power is out there and the value of things is compared to other things, and things eventually balance out, and you have your booms and your busts. And like I'm saying, China and silver in particular have been in a bust for so long. We're due for a boom. We're due for a boom. You know, again, is the eye bubble gonna pop and take down everything with it, including things that already seem undervalued? You know, Benjamin Graham actually does advise against buying anything, even if it seems undervalued, in an overvalued overall market, because he does say things that seem undervalued can become even more undervalued when the stuff really hits the fan. And I find it incredible. So many of the lessons I learned from that book, the Benjamin Graham Security Analysis, you know, the edition that I read from 1940 so long ago, and how these lessons can apply to markets today. It's really incredible. But I digress. Next chart, the triple Qs. I'm still short this market. And it looks like this isn't looking bullish. This is looking like sideways motion. You know, we've had a few trend lines that have been broken, and we seem to be under them, and I expect this market to continue selling off. Another important update, Bitcoin. If you've been following markets, if you follow markets at all, I'm sure that you're aware of what has been going on with Bitcoin. Of course, we hit very recently the 73,000 level, and today we have been continuing downward. We got as low as the mid 62,000s. You know, I do expect Bitcoin to continue lower from here. You know, it's such a speculative instrument. I mean, okay, it's not speculative because it was worth $1 and now it's worth $63,000. So therefore, it's a part of the monetary system. I pay my rent in dollars. I pay for my groceries in dollars. You know, I don't trust Bitcoin. I think it's a fun speculation that you can make more dollars on off of people that are dumber than yourself. You know, when it goes down, you buy it. When it goes up, you sell it. You short it. You know, I don't know. I think it's important just to realize cryptocurrency is still an extremely speculative asset. Is it an asset? It is a commodity. It's an online currency. I mean, I understand the value that it has to people, the utility of it, being able to settle transactions worldwide instantly. But again, like, the biggest use for it is for over controlling governments, sending money around the world likely for illegal activity for the most part. I mean, what else is it really for? Anyway, again, I digress. Let's move on. One of the more interesting charts that I came across today was actually wood. We had a huge green candle today, so I'm not sure what prompted this, but wood is a good leading indicator of markets, and this strength actually gives me a little bit of concern over my overall bearishness across markets, but it doesn't change what I think is happening here, but it does make me ponder, I mean, a little bit. I don't follow wood very deeply. I'm guessing it has more to do with some report, maybe a supply constraint. I'm not really sure, but I do like to keep track of this. Also, sorry about this chart. I'm trying to switch all of my charts over to TradingView. Yahoo Finance is trying to upgrade their whole system. It's just awful. I hate it. I liked I loved the Yahoo Classic Finance. They keep trying to push this new version of it on all of us, and it's clunky, it's ugly, it's just not good. I don't like it. I'm not convinced. Anyway, that's all I have for today's crystal ball reading and chart readings. I wanted to bring up two other topics for today's show. The first being earnings contraction. And so the main thing I want to bring up is that when borrowing costs go up and are restrictive, and the Fed knows that they're restrictive because companies are having to pay more money on their loans, essentially, it naturally makes it harder for companies to make money. The earnings of a company, the money that they're earning, is after they have to pay off the interest on their debt. And as that price goes up, as it has been going up and it's stayed elevated, it puts pressure on the earnings to go down. Now, I've been talking about how PE ratios have already been pretty high. Now, what happens when the effect of higher interest rates finally does start having an effect of earnings contraction, where earnings start to shrink? Well, what happens to PE ratios? They get worse. They don't get better. So a company that's worth $100, if its earnings ratio is 20, so it makes $5 a year. If that drops to $1 a year, well, now you have a PE ratio of 100. And an important thing to realize is that earnings can contract quite easily. Earnings is the leftover money. It's levered up. When a company is borrowing money to use, and it has to pay interest on that money, what it does is it takes the value of the stock, and the money left over can go down very, very quickly. I mean, to the point where it cuts into their ability to be able to pay off their interest payments. It can go to zero, it can go to negative very easily. Corporate bonds give stocks leverage, and when the cost of borrowing goes up, that leverage goes the other way, and so we can see contraction happening very quickly, and that shoots PE ratios even higher, which makes stocks that already seem overvalued right now to be, by definition, even less valuable. If a company is not earning money, the whole point of owning a stock is to own the earnings, the extra money coming in that the company can make. And if that's going down, which it can go down very quickly, I'm just saying, I had a recent video talking about the Magnificent Depression. This is a part of that playing out. High interest rates are more dangerous and can have a larger effect on the valuations of stocks than I think most people would like to even know about. So that was the first little side subject I wanted to bring up today. Another one I wanted to bring up is just following traders with trading patterns and trend lines and Bollinger Bands and gamma something, from Michael Silva's Figuring Out Money channel, or Fibonacci retracements. Every trader out there has their own methods that they're pushing out there. I think, I've been getting into Gareth Solway's channel more and more, and it's very tempting to want to just jump in with him and like, I don't know, quit my job and just day trade and follow his ideas. And that sounds great until I look at how many subscribers he has. 147,000 subscribers. And I'm wondering how many of these people are trading off of what he says. And the reason I'm laughing about this is only because, any chart reading, chart trading technique that exists anywhere is limited, ironically, by how many people are using it. And the more fame that someone like him gets, and the more popularity that he gets, the smaller the margin there is for his trades to work out to his favor, before it's so small that there's some algorithm in New York in a computer that figures out that all these people are doing this same type of trading, and they become the house, they become the casino, and the casino always wins. I appreciate on his show that he tries to be the casino and trade with he tries to be the ocean instead of the people that are always losing everything. But I mean, again, it's like the whole day trading thing in general. The biggest thing I want to just give for a takeaway on this, I honestly don't understand why he's sharing all of his knowledge, because the more popular it gets, the less effective it becomes. I don't know if he's aware of this, but that's just how it works. The more people that do what you do, the less effective it automatically becomes by how the markets work. If you have 1 million people doing the same trade at the same time, then they're all going to try. They all try to get out at the same time. It's like it's already gone. The trade's gone. And so it's like that kind of entertainment has entertainment value, and it's a good way to get out of trading. So you stop losing, and you become an entertainer more than you become a trader. If you have a trading technique that works, keep it to yourself. Don't share it. That's what I would suggest for anyone that has something that works really well. If you're trying to sell it to other people, then it's a different thing. You're running a business. You're getting income from selling your ideas instead of just doing the trades yourself. The most important takeaway on this idea is that the more popular any trading strategy becomes, the less effective it automatically also becomes. And that's it. Tomorrow's a pretty exciting day with the Fed coming out, with Powell talking about, what's going to be happening. It's pretty exciting times in markets. And that's all I have for you for today. I hope you enjoyed today's show. Thank you for watching. Robschild.